Yeah.
All right, let's stay on the markets here and bring in Lori Heinel. She is Deputy Global CIO at State Street Global Advisors. Lori, always good to see you here. So you just heard Inez talking about the move in big cap tech stocks. Is this just going to end badly? At what point do these stocks outstrip fundamentals?
Well, we've been modestly underweight to a lot of those big tech names for a while because we have thought that they were overpriced relative to the long-term future prospects. So we just have found better opportunities than other names. But it's hard to kind of fight the momentum trade right now. And so it wouldn't be inconceivable that these stocks continue to rally just because a lot of investors are afraid they're going to miss out. They do have growth tailwinds, but we think that the valuations are just relatively unattractive here.
Lori, what is driving these moves? Because to me, and I think for a lot of other folks out there, this is bubblicious type activity.
Well, it certainly isn't quite to the levels that we saw, back in the .com era, for example. So it's not bubblicious in that regard. But as you know, these are names that have continued to do well during a period when other sectors and other stocks have really struggled. So there's a lot of enthusiasm to just ride names that have done well. And as I said, the momentum trade continues apace. It doesn't have to necessarily end badly so much as that we just think that other sectors, other companies, other subsectors are going to catch up. And so we've been favoring other sectors as a consequence.
Okay, Lori, that leads me to my next question. What are some of those other sectors, and where do you think are a little more, fairly valued, if you will?
Yeah, so we think we're actually in the early stages of a recovery. And so we have been looking at more cyclical names. So we've been looking at banks, for example, where we think that there might be some relative valuation, and some of the earnings forecasts are so dire that it wouldn't be surprising to see the banks come in okay here. We also have continued to like healthcare. That's a space where, again, it's a lot about security selection, but we think there's some interesting opportunity there. And then very selectively, we've started to look at materials and industrials, in part because, again, some of those names have been very badly beaten down.
You mentioned the banks. We're going to start hearing from some big names in terms of their second quarter earnings starting tomorrow. What do you expect? What's your sort of biggest concern with the banks? Although you are saying you see opportunity there, what's your concern for going forward?
Well, look, there are plenty of things to be a little bit concerned about. I mean, certainly one is going to be non-performing loans. And so what kind of guidance do the banks provide in terms of loan loss reserves that they're setting aside? That might be a signal to how vulnerable they think that the consumer might be. The other side of it is that we've actually seen, for those banks that have exposure to capital markets, there has been heightened capital markets activities. So from an institutional side, that's been a source of strength. The other big issue that's going to weigh on banks for a while, we think, is going to be interest rates, right? So if we're right about our view that the Fed is likely to keep interest rates low for a long time, that obviously could put some pressure on banks. But we think that part of the story here is that the forecasts are pretty low right now, and so the opportunity to beat might be in order.
Lori Nasperay here. What do you make of the action that we've seen lately in semis? And we just had that deal of Analog Devices offering to buy Maxim Integrated. Are you bullish on the fact that semis are sort of broadening the scope of the rally in tech?
Yeah, well, certainly that's an area that's been a beneficiary more broadly as we move to more digitized device economies, Internet of Things of that nature. That's an area that's been a source of kind of consistent strength throughout. We actually do think that there's going to be a lot more M&A more generally, because here again, to the degree that you have stronger players looking for growth pockets, perhaps you'll have a few weaker players. Overall, we would expect to see heightened activity in the M&A sector as well.
Lori, what will you be listening to from management teams on these earnings calls? Because I don't think we're still going to get a lot of guidance. But how will you know that this rally it can continue?
Yeah, well, look, there are lots of things. I mean, as you note, a lot of companies have stopped giving forward guidance. So one of the things that we'll be looking for is, even if they don't give forward guidance per se, what are they saying about the future outlook? Are they starting to see a ramp up in orders? Are they starting to see a little bit of incremental activity? Certainly some of the sectors that have been most beaten down during this period of time, are they seeing the growth come through? The other thing is going to be cash. To what degree do companies have the wherewithal to weather the next downturn. This may be a 12-month or an 18-month environment that we're in. And so those companies that have cash flow, that have access to credit, they're going to be more able to weather the storm. So it's both the economic activity, but also what the resiliency is in their business models.
I'm curious how you are thinking about the upcoming presidential election. Do you think that the market is paying enough attention? Because it's going to be here before you know it.
Yeah, that's been, I think, the biggest source of our debate more recently is at what stage does the market turn its attention to the upcoming U.S. election? And we think that'll happen right after the conventions, probably in August. And certainly that will bring a whole nother set of concerns for investors, because depending upon which candidate is moving to the forefront, that may have implications for policy, have implications for which sectors will do well. So we think that's going to create a lot of choppiness in the fall as well.
Lori, is it, so far the market has shrugged off some of the proposals that potential president or now Vice President Joe Biden put forward last week. Is it as simple to say as his plan is anti-stock market and anti-investing? And as someone who manages money, that type of plan will cause you just reconsider how you invest and allocate your portfolio?
It's interesting. Conventionally, there has been this kind of meme that one or the other party is sort of pro-market or anti-market. I think the situation is a lot more nuanced, and especially when you think about the various policy imperatives that we've had under the Trump administration versus what we might see under a Democratic or a Biden administration. So they have very different views on things like energy, like healthcare, like financials. So it's less about are they market friendly or unfriendly, and more about where might be those tailwinds and headwinds. And so we do think that a Biden administration would have a different view on some of those sectors that I just mentioned.
I want to stay with politics for a minute because, unfortunately, unemployment benefits in this country have become very politicized. If we don't get an extension on that extra $600 a week for unemployed at the end of this month, does that have any impact, you think, on the markets?
Well, look, one of the things that's been propping the markets up is that the markets are forward-looking. So there is this view that we've marked the bottom in April, and so we're going to start to see improving data, and that is happening. And part of the reason for that has been this massive fiscal and monetary stimulus, which has certainly helped, create good savings for consumers, the opportunity to spend when they do have the ability to get out and actually spend those dollars. So we do think that anything that sort of jeopardizes that safety net could have a negative impact. But the other side of it is we're starting to see offsetting improved economic activity. So the employment picture is not as dire as it was. You're starting to see, retail spending. Again, consumers do have adequate savings. So while we think that it would be advantageous to continue to provide these safety nets, especially given that we don't know where we are really in the pandemic, we do think that there are some underlying fundamentals that will actually continue to propel the economy forward.
Well, Lori, as always, we hit you with a ton of questions, and you hit a home run on every single one of them. Lori Heinel, Deputy Global CIO at State Street Global Advisors. Always good to see you. Have a good week.
Great to see you. Thanks.